to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mansell, founder of Mansell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the FTSE All-World ex-US Index. It's tracked by Vanguard's VEU ETF in both Australia and the US, and as the name suggests, it's ex-US, so that's Europe, Asia Pacific and emerging markets. So it's a combination of markets outside the US. It also includes Australia, and some people choose to use this index in conjunction with the US total market index, and that's basically the portfolio. And what's interesting with that approach is the ability to under or overweight the US versus the rest of the world, depending on how you feel things are going in the US. And we won't mention the name of the orange gentleman because we found YouTube seems to take offence. But lately people have been saying they want more of the rest of the world exposure for quote unquote reasons. So we'll take a look at what's happened in the rest of the world over the last 25 or so years. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make us tap to sign. These are simple concepts. We'd like investors to better understand risk so they can make informed decisions. The periodic performance, and this one's only been around about 25 years, but well diversified, 3,600 stocks around the world. Also, as I've noted, includes Australia. And to put that in perspective, CBA and BHP sit inside the top 30 for this one. And for comparison, below the US total market is there, and these are Australian dollar returns. And while the 10, 15 and even 20-year returns aren't awful, 25 years under 5% for an equity return isn't probably something you'd want, but it's always a possibility.
Absolutely it is, and it's a very clear indicator that the US stock markets have been a very major driver of investor returns over the last 25 years. And in particular, Europe has been very much the laggard over that period of time. Asia, reasonable, although Japan, quite the laggard, for a number of those 25 years. So again, it's important for investors to understand that if you exclude a major part of the major financial markets from the portfolio you construct, you might be fortunate and get a good result, but you may well miss out on what proves, and in this case, over 25 years, has proven to be the major driver of stock market returns.
And some people might say, oh, well, this is why you exclude Europe going forward or something like that. But at the same stage, this is just a period and it's no guarantee that it's going to continue.
My recommendation to investors that conclude that would be you would have just missed out on what has been incredibly strong returns out of the United Kingdom, even more so out of Germany. And with the recent activities in relation to tariffs and trade, it's not a surprise that investors say, hang on a minute, not so sure about whether I want to invest in the United States. Maybe I'd be happier allocating my capital to Germany or France or Italy or the United Kingdom, or maybe, to the Asian tigers, maybe even little old Australia. But when we see difficult economic trading conditions driven, particularly through the political realm, it can make investors nervous. And if that's the case, capital will find its home somewhere else.
And like I said, calendar year returns may seem a little simplistic, but they do give you a view you don't often get looking directly back from today. And while this is missing the first 7 months, the index existed, I can tell you it was down 4.43%, and combined that first 31 months knocked off 2.57 off the annualized return.
I look at this table and just clearly it says that people were very pro-Europe through to around 2012, and then they were very pro the United States after 2012. And I think it's fair to say that the big part of that second half of this chart relates to the tech sector and the way in which that has absolutely thrived in the recent 12 years. And it's fair to say that that's a sector that the US well and truly leads the world.
Yeah, I mean, if you exclude the first few years and compare the rest of them, the returns aren't exactly terrible. It's just that the US has been very exceptional post 2010.
100% correct, Daniel.
Growth of wealth, and this is a good illustration, as you can see, around 2011, 2012, the gap between the two narrows after Europe was doing a little bit better. It wasn't doing fantastic, but it was doing better than the US. They crossed in late 2014, and the growth in the US from that point was just pretty much astounding, double digits all the way. And some people might say, well, this is why you exclude something or get more of something else. And I'd say, well, it's probably actually the argument for diversification, because your hunches on what come next might occasionally be right, but they're not going to be right consistently. And it's easy to make pronouncements in hindsight when you've got a clear head and no noise around.
Absolutely. To me, this is a great illustration of two halves where if an investor made a deliberate choice that turned out to be wrong, they end up with a terrible outcome. Imagine if you had started this period thinking, oh no, America's the place to be. It's the land of opportunity. And eventually, you lose faith at 2012, and then you go, oh no, I'll invest in everything but the United States, right? By the end of that period, you wouldn't even have the $3.31.
And range returns, unfortunately, not a massive amount of data to judge, but a little bit lower through the middle than you'd like to see.
Yeah, again, it's a relatively short data series. Generally when we create this chart, we're looking at much longer than 24 years. So I wouldn't worry too much about those average numbers, but concentrate on the ranges. The ranges are really the indicators that the investors need to understand best.
And rolling returns, this is a really easy to understand chart in comparison to the US total market. It's, again, chart of two halves, each shades the other, but also important to remember Europe is 40% of this index, and it was in a really bad way post GFC. There was talk the Eurozone may break up. It was getting that bad.
Sure. Again, it's a bit like one of the earlier tables. It's the story of two halves. Team Orange won the first 12 years and Team Blue won the second 12 years. You just want to make sure that you don't start off on Team Blue and then swap to Team Orange. If you do, you're sure going to suffer.
Historic chance of positive, negative. This might be the first one we've seen where the chance of a positive 1 month return has been under 60. So obviously a shorter time period though.
There's another reason I think that leads to that being a possibility, and that is you've just taken literally the 800-pound gorilla out of the zoo. And why wouldn't you have some more volatility as a result of that? And the narrower any market you invest in, the greater the possibility there is of an extreme outcome.
And largest fall in time to recovery. So the first half year is the actual largest fall in time to recovery, which is down 45.63% in over 63 months. But it shows the rest of the world also kind of saw a lost period, even though it did erase it temporarily. And for investors in Australia, I'll drag the ASX into this conversation because while this was going on and the US looked kind of similar to this, much actually worse, over the same time period, global stocks and US were down. The ASX 300 total return was up 200%.
Yeah, to me, the salutary lesson here is that, yes, what went down came back up again, but it doesn't mean that has to last. The excessively bad news rarely lasts. The extraordinary good news rarely lasts. Investors need to have patience and understand absolutely, that you could have a period such that we're looking at here, which is nearly 12 years in aggregate with very little positive return. Now, in part, that can be the starting point. In part, it can be the end point of the graph. But at the end of the day, investors have to understand it's possible. The most important lesson is not to get to a point of exasperation where you eventually give up and miss out on the upsides that do eventually arise.
And risk return or efficient frontier, and it was a bond-like return with stock-like volatility over this time period. But in saying that, it means nothing about the future. You could toss these balls in the air and they could land differently over the next 25 years. You'd probably expect the bonds to stay somewhere near where they are, maybe a slightly lower return, but I'd probably expect the differences in the equities to maybe narrow.
I think that's a valid statement. If we were able to look at 50 years of data instead of 25, I suspect that the green diamond would rise much closer to the two orange dots on the right. The other thing I'd add is that if we were looking at just the US market for this 25 years, it will be above the two orange dots to the right, and it'll probably be just a little bit to the left in terms of volatility. And as we've alluded to already, Europe and the rest of the world were the other half of the team. It just so happened that the US have won the game over this 25 years. Doesn't mean they will the next 25.
And sources and descriptions of data. Thanks for your time.
Okay, bye for now.